So when I say that this is where an individual or entity does not use double entry system, in bookkeeping. In bookkeeping is where an individual or entity does not use double entry system in bookkeeping. In bookkeeping. All right, so another point you can write and say that they maintain a reduced amount of information. They maintain a reduced amount of information on their financial results. On their financial results. Then you can write another point and say that under incomplete records, an individual is required to prepare one, a statement of affairs. A statement of affairs is used to determine the capital. Number two, the income statement or the profit, the statement of profit or loss. Then number three is the statement of financial position. Statement of financial position. So we'll be looking at incomplete records of a sole trader or of a sole proprietor, and see how we record them or how we adjust the incomplete or the unavailable information So the statement of affairs, we take the assets minus liabilities, or we follow the accounting equation, which says that our capital equals to assets minus liabilities. Then the income statement is that the normal statement that we prepared under the sole trader. It's only that we'll be required to find some items when preparing it. Then also the statement of financial position is the same. It doesn't change, the same format. It's only that also we will determine some of the missing figures under the records given. So we'll start by looking at a question. In November 2015. Question 1, November 2015. Question 1, we are told that Juma Makori is a businessman based in the Central Business District. He does not maintain a complete set of accounting records. The following balances are available from his books of account as at 31st May 2014 and as at 31st May 2015. 31st May 2015. So we are given the balances there for the assets and liabilities. We have the machinery, we have all the amounts, equipment at net book value, we have motor vehicles, we have trade, Receivables, at the beginning of the year, we don't have. It's a question mark. Trade payables, we have at the beginning, at the end, we don't have. And we have inventories, we don't have the opening inventory. It's a question mark. We have bank loan, we have cash. At the end of the year, we will determine. Then we have outstanding electricity bills. We have an expired insurance. Then we are told that the cash transactions during the year ended that 1st May 2015 were as follows. We have collection from customers, those are receipts. That means they will affect the trade receivables, and they will help us to determine how much were the trade receivables at the beginning of the year. We have payments to suppliers. Those are payments to the creditors, and they affect the payables, and also they will help us to determine the amount of payables as at the end of the year. We have cash purchases, we have electricity bills, rent, insurance, salaries, and wages, sale of equipment. Sale of equipment will determine whether it was sold at a profit or at a loss. Then we have drawings. Drawings reduce capital. We have interest on loan. Then we have acquisition of equipment. That was an additional equipment. So we'll add it to the equipment that we had in the beginning of the year and determine what will be or what was the depreciation at that time or so. Then we have additional information. For the additional information one, we are told that cash sales amounted to 10% of total sales. Cash sales amounted to 10% of the total sales. Then let's see additional information two. We are told that the credit sales amounted to 7290. Credit sales equals to 7290. If the cash sales are 10% of the total sales, that means the credit sales, they were 90%. They were 90% of the total sales, So to get the cash sales, So we'll say first we'll determine 100%. We'll determine the total sales, which is 100%. 100% will be equal to what? 100% will be equal to what? If 90% equals to 7290 equals to 7290 equals to 7290 equals to 7290. So this is what we'll have. Total sales will be 7290 divided by, or multiply with 100 divided by 90. Divided by 90. This is 8. This is 1. So this is 8, 10. This is 8, 10. That means no, this is 90. That is 81. That means total sales. That means total sales equals to 81. So 10% of 81 will be the cash sales. The cash sales. 10% of 8100, which will be 810. So the total sales is 8100. Total sales is 8100. Total sales is 8100. Total sales 8100. Then we continue to additional information 3. Additional information 3. We are told that credit purchases amounted to 80% of total purchases. Credit purchases is additional number 3. The credit purchases equals to 80% of the total purchases. Of the total purchases. And we are told that the cash sales given under the transactions above, we are told that they were 864. If credit sales are 80%, that means the cash sales were 20%. They they were 20%. So we want to determine how much was the total sales, how much was the total sales, and we say if 20% equals to 864, how about the 100%, which will be 864 multiplied with 100 divided by 20, and this will be 5 there. So 864 we multiply by 5. 864 multiply by 5. 864 multiply by 5. 864 multiply by 5. So the total sales equals to the total sales, not so total sales, but total purchases, equal to 4320. 4320. That means now the credit purchases, will be 80% of 43, or 4320, or 4320, or 4320, or 4320, which is 3456. Which is 3456. 3456. Then we have additional information for all sales are at a profit markup of 33 and a third percent. 33 and a third percent. 33 and a third percent. 3 and a third percent. So we have number 5. The suppliers allowed him a discount of 54, and he extended a discount to his customers of 4,500. So we'll have discount received there. Discount given by the supplier to Juma Makori, that is the discount received, and it's the 54,000, which is 54. Then he also, after he was given a discount by the supplier, he extended a discount to his customers of 40.5. That is the discount allowed, 40.5. Then we have number 6, outstanding debts of 121,500 proved irrecoverable and were written off. Those are bad debts, irrecoverable debts, or they are the bad debts written off. 121,500. That's 121.5. Then we are told that depreciation is to be provided as follows. Depreciation. We have the depreciation. Depreciation we have for machinery. We are told that depreciation is to be provided. Machinery 15% on cost. 15% on cost. 15% on cost. That means you take the rate multiplied by the cost of equipment, multiplied by the cost of equipment, multiplied by the cost of equipment. Not equipment. Is that machinery? Sorry, that is machinery, not equipment. Machinery. The cost of machinery is 3240. Machinery, not equipment. So we have 15%. We multiply with 3240. And that will give us 486. Then we have motor vehicles, 20% on cost. The motor vehicles, 20% on cost. The cost of motor vehicles is 1270. 20% of 1270. Which is 254. This 254. So this was additional information 7. This was additional information 6. This is additional information 5. And that was additional information 3. Additional information 4, we say that the sales are at a profit markup of 33 and at that, 33 and at that. 33 and at that. So that was the profit on the cost of sales. That was the profit on the cost of sales. on the cost of sales, profit on the cost of sales. That one will help us to determine the inventories which are missing. That one will help us to determine the profit, I mean the inventories which are missing, So for additional information 4, profit on sales, we refer to it as margin, and profit on costs is what we refer to as markup. So to refer to as the markup is what we refer to as the markup. So to refer to as the markup. So in this case now, we are given markup on sales. That means we need to change that markup to margin. We need to change that markup to margin. And we are told that the markup is 33 and a third percent. 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 So if you are to express this as a fraction, if you are to express this 33 and a third as a fraction, that will give you 1/3, or it is a third. That is a third. And we say that the profit on sales is margin. And how do we get sales? It's what? It is the profit plus cost. So to get the margin will be the cost, which is 3 plus 1, which is the profit. The profit remains constant. So we'll have 4. That is 4. So to have margin, to have the margin now, we'll have 1/3 plus 1/1. So we'll have here we have 1. This is adding up to 4, which is the selling price. This selling price is the selling price. Is the selling price, which equals to 3 plus 1, which is 4. Then the margin is now the profit on selling price, 1/4. 1/4. 1/4. 1/4. So we'll determine how much was the profit. How much was the profit by getting 1/4 of the sales. So the profit will be 1/4 of the sales, 100. This will be the profit. 1/4 of 100. Which is 2025. So this is 2025. That means the sales minus the cost of sales should give us 2025. So that is the gross profit. In other words, that is the gross profit which was made on the sales, which was made on the cost, which was made on the cost. So that's how we interpret that. And now this question will be working backwards. We'll work backwards and see the values which we are supposed to refill. So you can put down the income statements. You have to put down the income statements. Put down the income statements. So this is Juma Makori. Income statement. For year ended at 1st May 2015. So we have sales, the figures are in thousands. We have the sales. Sales we got 8100. There were no return inwards. So we less the cost of sales. The cost of sales, we start with the opening inventory. Then we add purchases. The opening inventory was a question mark, but now we have the total sale purchases. Total purchases is 4320. 4320. Then we minus the closing inventory. The closing inventory we were given there as 91.8. 91.8. So after that, the opening inventory plus purchases minus closing inventory should give us the cost of sales, whereby the cost of sales to talk about sales should give us the profits 2025. So we determine how much now was the cost of sales. Cost of sales 8100 to get the profit will give us the cost of sales, which is 6075. 6075. Then 6075, we are working backwards so that we can determine the opening inventory. For 6075, we add 91.8. We add 91.8. Then we minus the purchases, 4320. And that will give us the opening inventory of 1846.8. 1846.8. Then from there, we check whether we have any other incomes, and we have discount received. So we add other incomes. Other incomes, we have the discount received, which was for 54. Then let's see whether the equipment which was sold at a profit. We are told that under the transactions, sale of equipment with a net book value of 270 was sold for 370. That means it was sold at a profit on sale of equipment, which is 378 minus 270. And this is 118. That is 108, sorry, 108. That is 108. 108, that's a profit of 108. Then from there, we charge the expenses, or we record expenses, so less expenses. For the expenses, we start with electricity bills. We have them there, electricity bills. But the electricity bills, we have an adjustment per due under the balances of 2014 and 2015. Electricity bills, we are given first 229.5. Then we are told that we have outstanding electricity bills, outstanding expenses. Those are accruals. And accruals at the beginning of the year we less, at the end we add. So we add 67.5, we less 40.5. We less 40.5, we less 40.5, we less 40.5. So this will give us 200 and, that will give us 200 and, that is 229.5 plus 67.5 minus 40.5. That will give you 256. 256.5. That's an expense. Then we have rent. We have rent. Rent is given an amount of 324. We have insurance. Insurance, we have an expired insurance. That is prepaid insurance. So we have 97.2. Prepaid insurance at the beginning of the year, we add plus 32.4 minus 24.3. So we have 97. We have, that is 97.2 plus 34. That is not 34, that's 2 plus 32.4 minus 24.3 to give us 105.3. That is insurance. Then the next one, we have salaries and wages. Salaries and wages, there are no adjustments about that. 202.5. 202.5. Then we have number 6, additional information number 6, we have the bad debts written off or the recoverable debts. 121.5. 121.5. We also have interest on loan. We are given there the second last item, interest on loan, 48.6. Also, we have depreciation. We have depreciation for machinery. Depreciation for machinery. Depreciation for machinery. Depreciation for machinery, we calculated and we got 486. And also for motor vehicles, we calculated and we got 254. Got 254. 54. So for the equipment, these are how we will see whether it is depreciated. Just draw a small equipment account. Small equipment account there. But we have the balance breakdown. The balance breakdown. Balance breakdown of, we are using the net book value 1620, and the balance carried down was 32, not 32, but 1998. 1998. Then we are told that we have and equipment which was sold, disposal, and it was disposed ikiwa na net book value of 270, net value of 270, value of 270. So let's see whether it depreciated. Want to see whether it depreciated. So the balancing figure. So if there's a balancing figure also, but they purchased another one. Before that, they also purchased acquisition of equipment 810. So the balancing figure will give us the depreciation. The balancing figure will give us depreciation. So we have 1620 plus which they purchased 810, that is 810. Then we less 270, which was sold. And also we less now the remaining balance of the equipment, 1998, to give us depreciation of 162. So that means equipment also depreciated with 162. So we record it under depreciation. For equipment, 162. So from the gross profit, we add the other incomes, then we realize these expenses will give us the net profit for the year. The net profit for the year that Juma Makori had made.